and we'll just jump in. I don't have a lot of I guess generalized announcements. Maybe one. I've had several questions on how to do the peer reviews for the paper. The instructions maybe are a little confusing, but in essence, to do the peer review, you just go back to the week 4 initial submission assignment, and then up in the upper right hand, there should be a link to papers you can peer review. In fact, let me share my screen and show you how to do that. So here I am at the home screen. Just go to your modules. And even though we're in week 6, to do the peer review, you just go back to week 4. And you go to that assignment, which was called week 4 paper initial submission. And then over here on the right-hand side, you'll have some peer reviews that are assigned to you that you can click on. A lot of people are trying to get through it through the week 6, and so it's confusing. But you have to go back to week 4, to the week 4 paper initial submission, and that's how you do it. Another thing, let me take you back to the module real quick. If we go to week 6 and we click on peer reviews, again, it's a little confusing because it tells you go after the week 4 paper initial submission, go to that assignment and find your assigned peer reviews. That seems a little confusing. It's just telling you to go back to, like I said, the week 4 initial submission. Tells you to review the rubric, open the assigned peer review and read their document. Provide your critique by annotating directly into their document. So you can right there in the peer review system, you can annotate right into their paper. You have to complete the rubric. And then this one is what people always miss. It says add a comment to the comment box. It could be as simple as saying like, I've reviewed your paper, or good job on your paper. All that does is it marks it as done. So when you put a comment in the comment box, it'll mark it as done, so that when I go to grade it, I'll see that you did it. Otherwise, if people do all this other stuff, they do the rubric, they put comments in there, it doesn't show up as done. And then when I'm grading it, I give them a 0, and then they send me a nasty email saying, hey, I did that. And so just follow the steps here in the instructions and it'll be fine. Anyway, so that's just something people miss a lot. So again, you know, I feel like the course designers they string this paper assignment out over weeks and weeks and weeks. It's like a 1-page paper. I would not put tons and tons of time into it. I mean, on the peer review, do give some meaningful comments if you can to the person whose paper you're reviewing, help them do better. But it's something I would spend 20 minutes on, not 2 hours on, honestly. I mean, unless their paper really, really needs help and you feel like you have the capability of giving that help, then great. Anyway, so that's really all I have as far as general announcements that aren't specific to this week's lesson material. Any questions about general things that aren't specific to the accounting material for the week? Okay, yeah, go ahead.
So for week 6, we have to go back to week 4 to be able to do this assignment?
Right, when you go back to your week 4 initial submission assignment, that's where you will see the links up here in the upper right hand side for the peer reviews. It's a little confusing. All right, are we good? If you want to move on to, I have a little bit of information put together about this week's chapter. And then I can go to some specific more specific questions if you have them. So give me a second to pull that up. Chapter 5. All right, I'm actually going to bring this over here. Okay. So this week we're talking about chapter 5, which is a merchandising company. Really, what we've done up to this point has been service-based business. So they're selling services to people. But this week we're talking about companies that sell products to people or merchandise. So let's see. Yeah, I think that is. So I just wanted to, the first thing we need to think of is so if we're a business that purchases things from from another business called a supplier, and then we sell those to other people, the first thing we have to do when we're figuring out how to do these entries is recognize our role in the transaction. Sometimes our role will be that of a purchaser. We're buying the goods from somebody else. And sometimes our role will be that of a seller, where we're selling the goods to somebody else. If we don't understand our role as a purchaser or a seller, then it's going to be impossible for us to know how to make the correct entries. This is one of those ways where learning about accounting in school is actually harder than in real life. In real life, it's obvious if you're buying something or if you're selling something, but in a classroom setting where we're doing word problems, you have to kind of carefully read it to make sure you understand, oh, I'm the purchaser or I'm the seller. So that's the first step to getting this that a lot of people get hung up on. So here's a sample of what it would look like to purchase merchandise from a supplier. So we have Sock Stereo, who's the buyer, uses a purchase invoice. I'll use a sales invoice prepared by PW Audio Supply. Prepare a journal entry for Sock Stereo for the invoice from PW Audio Supply. So when we purchase something, it's going to just look like this. We're going to debit the asset account inventory. Inventory is just the stuff we have available to sell. Okay. And then we're going to credit accounts payable, meaning we owe that supplier for this. If we had paid the supplier in cash, then it would look the same, except it would say we would debit inventory and we would credit cash. Okay. So there's a basic purchase entry. Now, of course, it's not that simple, right? Because it's accounting, and I mean, we wouldn't need a class for it if it was that easy, right? We would just do it. So the first thing we have to worry about is the cost of freight, meaning the cost of shipping the product that we buy to us. Again, we have to know, are we the buyer or are we the seller, okay, in any given shipping transaction? And so there's a couple of terms that are introduced in this chapter that confuse people sometimes. And the terms are FOB shipping point and FOB destination. FOB means freight on board. It just means that by freight, we mean that the product that we're selling or buying is on board the vehicle that's carrying it to the destination. Okay. So when we say that our freight costs will be FOB shipping point, what we mean is that as soon as the seller loads it on the truck or the plane or however they're sending it, so as soon as the freight gets on board, then it becomes the property of the buyer. Okay. And because of that, the buyer is going to pay the freight costs or the shipping costs. So FOB shipping point means that ownership that the transfer and ownership happens when the seller delivers the goods to the public carrier, in other words, the shipper. Okay. And so if the ownership changes here, then it's going to be the buyer's responsibility to pay the cost of getting it to them. Okay. FOB destination means that once the shipper gets the product to the buyer, then it becomes the ownership, or becomes the property of the buyer. So ownership doesn't change until it gets to the buyer. So in FOB destination, because the goods belong to the seller the whole time they're being in transit, the seller is going to pay the cost of transportation. So those two things confuse people. And once you like work it out in your mind, it's like, oh, that wasn't hard, but it's really confusing at first. So just recognize FOB shipping point, ownership changes at the shipping point. So the buyer pays because the ownership switches to the buyer before it's shipped. And FOB destination, ownership changes at the when it reaches the buyer. And so because it belonged to the seller the whole time, the seller pays for it. That's the most important thing to know. You have a question? Looked like I saw a question.
Yeah, I do have a quick question. So the point one and the shipping one are two separate entities, um, but it's focused on ownership. It's not necessarily focused on payment. Would we debit the payment when we got ownership, or when we wanted the product and we gave it to the selling company?
Yeah, good question. So it is based primarily on ownership, but the idea is that the owner pays for the shipping cost. Okay. So if we purchase, if we're the seller, okay, again, we have to know our role. Are we the seller or the buyer? If we're the seller and we sell something FOB shipping point, then what we're going to do is the seller, as soon as he loads that on the ship to the shipper's vehicle, he's going to go ahead and record that entry and show his inventory going down. So he'll credit inventory, and he'll credit an accounts receivable that the buyer owes him money. Okay. The buyer, as soon as he gets word that it's been shipped, is going to debit their inventory account and credit their accounts payable account. So because it becomes their property as soon as it's loaded on the carrier. Okay. With FOB destination, the seller is not going to do anything when they load it on the public carrier or on the shipper until they get some type of notification that the buyer has received it. Then they will go ahead at that point and enter the sales transaction into their books, and the buyer will enter the purchase transaction into their books. Does that help? Good. Okay.
Yes, it does. Thank you very much.
All right. So here's a couple examples. So it says, assume upon delivery of the goods on May 6th, Sox Stereo pays a public freight company $150 for freight charges. The entry on Sox Stereo's books is. So here's an interesting thing. If you're the purchaser, if you're the buyer of the goods, then you are going to add those freight charges to your inventory account. Why? Because it's part of the cost of the inventory that you're going to sell to your customers. So if I purchase goods from a supplier, I'm not only going to debit the cost of the goods themselves to my inventory account, I will also debit the cost of getting it shipped to me, to my inventory account. So all of that will add up and will represent the total cost I paid for that inventory. So just remember, if you're the purchaser, then freight charges, if you're paying the freight charges, then the freight charges will be debited to your inventory account. In other words, they'll increase the cost of your inventory. If we did it the other way and the supplier was paying for the freight, they would just debit an expense called freight out, or sometimes it's called shipping expense or freight expense. Different businesses will give a slightly different name. So if you're the seller and you're paying for the cost of shipping, then you just expense that, take it as an expense right then at that point. Okay. So that confuses people. So this is why it's so important to understand, am I the buyer or the seller? If I'm the buyer, I'm adding the cost of freight to my inventory. If I'm the seller, I'm going to just take it as an expense called freight out or freight expense or shipping expense, something like that. That can be confusing. All right. The next piece of this are what are called purchase returns and allowances. So again, this is from the purchaser standpoint. When you're the purchaser, um, sometimes you will receive goods from a supplier and they'll be damaged, or they'll just be the wrong thing, or you decide you don't want them for some reason, and so you return them. Um, and so it says, assume Sox Stereo returns goods costing $300 to PW Audio Supply. So all we do when we make a return, if we're the purchaser, is we debit our accounts payable. Okay, remember accounts payable is a liability. So by debiting it, we're reducing that account. We now owe the supplier less than we owed them before, and we credit inventory. Inventory is an asset account. So again, by crediting it, we're reducing that account. So if you think about it, it makes sense. We're sending those goods back to the supplier, so our inventory account goes down by the cost of them, and our accounts payable, the amount we owe, also goes down. Okay, that's what it looks like from a purchase side. A purchase allowance is slightly different than a purchase return. A purchase allowance is when you call your supplier and you say, hey, this is the wrong thing, or it's damaged, or whatever, and the supplier says, hey, that's our mistake, we're sorry, go ahead and keep it, and we will reduce the amount that you owe us. And so when you do a purchase allowance, a lot of times your inventory won't change, but your accounts payable will. So it's a lot of times just, it's kind of like the supplier is giving you a credit, is what they'd call it, because they made some error or something on your account. All right, so purchase discounts. So oftentimes suppliers will offer a discount to the purchaser if they will pay their account in a timely manner. This is just to encourage cash flow, right? To get people to pay faster. So you have to kind of learn this annotation, which you've probably already seen if you've started into the homework this week. But this annotation, 2/10, comma, n/30, that means you get a 2% discount if you pay what you owe within 10 days, or the net, which means the full amount is due within 30 days. So this means if you pay within 10 days, you get a 2% discount. You can choose to do that, or you have 30 days to pay the full amount. 1/10 EOM means you get a 1% discount if you pay within the first 10 days of the next month. N/10 means the net amount is due within the first days of the next month. So EOM just means in the next month. So always you'll see this annotation, it might be 3/10, which would be a 3% discount within 10 days, net 30, or you'll see a 3/10, net 60. Just understand what this annotation means so that you can apply the appropriate discount. So here's an example. Sox Stereo pays the balance due of $3,500. The gross invoice price was $3,800. Minus they had their return of $300 that we did earlier. On May 14th, the last day of the discount period, they go ahead and pay the amount due. So if they owe $3,500 and they pay within the discount period, then we're going to record it this way. So their accounts payable will go down by the full $3,500 that they owe. So we debit accounts payable, but they only have to pay $3,430 in cash because that's the amount they owe minus the 2% discount. The discount we actually record as a decrease to inventory. And this is kind of confusing because people think, wait, my inventory is not changing. The amount of stuff I have to sell isn't going down. We have to remember that inventory is the cost of the stuff we have to sell, not the actual physical items of it. So by getting this discount, we're reducing the inventory account by $70, meaning we're showing that our inventory cost us $70 less than what we had originally recorded. Okay, so whenever we do a discount and whenever we pay something within the discount period, it's going to look like this, where our accounts payable will go down by the full amount we owe. The cash account will go down by the amount we owe less the discount, and then the discount will be a credit to our inventory account. Always the same process. So if Sock Stereo failed to take the discount and instead made the full payment of $3,500, it would just look like this, where we debit accounts payable and we credit cash for the full amount. Okay, so now what we are looking at mostly there is from the perspective of if we were the purchaser. So now if we change it around and we're the seller, because a merchandising company is both, right? They buy things, they purchase from the supplier, and then they sell things, they sell to customers. So, um, so whenever we make a sale, we always have to do 2 entries. Okay, not the same as when we purchase where we just did 1 entry. Here we have to do 2 entries because a couple of things are happening. First, we are selling the product to a customer at its full sales price or its retail price. Okay, so we have to debit our accounts receivable account if we are allowing the customer to pay in the future, or our cash account if they're paying us in cash right now. And we have to credit our sales revenue account. This is the price that we sell it to at the customer or sell it to the customer at. The second entry recognizes that we are removing these items from inventory, and that's recorded at our cost. A successful merchandiser will always sell things at a price that's higher than their cost, right? Or else they'll go out of business. So the second entry would be a debit to cost of goods sold and a credit to inventory. John, did you have a question?
No, I'm good.
Oh, okay.
Actually, I did have a quick question. I know it's kind of off note, okay? But I was going through the exercise yesterday. Actually, can I talk to you after class about it?
Yeah, we could talk about it later.
Okay.
Yeah.
Yeah. Sorry. Okay.
All right. So here's an example. PW Audio Supply records a sale of $3,800 on May 4th to Sock Stereo. So their first entry will be the amount they sold it to Sock for. That's how much is owed to them, $3,800. And their sales revenue will go up by $3,800. But then the second entry is the cost of goods sold and the inventory at their cost. And so if you think about it, if you took our revenue minus our cost of goods sold, that would be our gross profit on the transaction. That's be the amount of gross profit they made on the transaction. So always for every sale, there's 2 entries. There's what I call the retail entry. That's the amount we sold it for. And that's going to be accounts receivable or cash, depending on the nature of how we sold it. And then a credit to sales revenue. And then the cost entry, which is going to be our cost of goods sold, which is an expense. And then the reduction of our inventory at the cost. Always, every time we sell something, that's going to be the entry. All right, returns and allowances and how we handle them from the perspective of the seller. So we looked at how we handle them from the purchaser. From the seller, let's see. So we have prepare the entry PW Audio Supply would make to record the credit for returned goods that a selling price of $300, assume a $140 cost. So if we're the seller and our customer returns goods to us, then what we're going to do is we're first going to debit sales returns and allowances. This is a special account. It's a contra revenue account, actually. So it reduces our amount of revenue. Okay. And then we're going to credit accounts receivable. The second entry will be to add those goods back into our inventory, because if someone returned them to us, then they come back into our inventory, and that happens at the cost. And then we will credit cost of goods sold. Okay, so this is, if you think about it, it's sort of the reverse of the sales transaction, where we're gonna show at the retail price first, debit sales returns and allowances, credit accounts receivable, and then at the cost, we debit inventory and credit cost of goods sold. All right. So one last thing that they introduce in this chapter is what's called a multi or multiple step income statement. This is right here. What we're looking at is an income statement you're probably familiar with, but what we haven't had up to this point, we haven't had gross profit. We haven't had operating income, and so these are new items that give more detail, I guess, to the income statement. So we start with what we sold, and then minus our cost of goods sold. That's an expense, but it's a special expense, and so they always list it separate up here. What makes it special is the more we sell, the more our cost of goods sold will be. So as sales go up, so will cost of goods sold, okay? Because it's the stuff we're selling. As opposed to something like our rent, which will stay the same whether we sell $1,000 worth of stuff or $10,000 worth of stuff. So our sales minus our cost of goods sold is our gross profit. Then our operating expenses. That will give us, so our gross profit minus our operating expenses will give us what's called income from operations, or sometimes they call it operating income. Then other revenues and other expenses. These are non-operating revenues and expenses. They could be things like if we sold off a piece of property that we, and made some money on it, or sold off some investments, they would go here because they're revenues, but they're not part of our regular day-to-day business operating revenues. Okay. And then we have net income at the bottom. And then an expanded multi-step income statement might even show all of the sales information. So now it shows sales, less any returns and allowances, less any discounts. That gives us what's called net sales, or cost of goods sold. Net sales minus cost of goods sold is our gross profit. All of our operating expenses. So our gross profit minus our operating expenses gives us our operating income. And then minus any, or plus any other revenues, minus any other expenses. And that will give us our net income. So it's not really radically different from the income statements we've already done. It just has more detail. Instead of just sales revenue or service revenue, it's going to have sales revenue minus the discounts and returns. It's going to break expenses into operating expenses and then other gains and expenses. So it just provides more detail. But other than that, it's the same concept. It's still our sales minus all of our expenses ends up being our net income. Okay. So that is it. And that is plenty of new stuff to try to figure out for 1 week. Does it ever feel like they just keep loading new stuff onto you in this class more and more every week? That's how it's structured. And it's the same every college I've ever been at. So it's just kind of mean. Anyway, questions about that, or questions about something specific from the homework?
I have a question.
Okay.
So the last multi-step income statement that you showed us, is that only specifically when you sell items, or it's also for services?
So if you have a business that only sells services, then they're not going to usually have a cost of goods sold. They might, sometimes you'll see like cost of service, if they can break that down. It all depends on the business, the size of the business. For a lot of small businesses, it's not worth it to them to try to break down into all those little sub costs. But the short answer is cost of goods sold is only for merchandise businesses. So if it's a pure service business, let's say a massage therapist or something like that, then you wouldn't see a cost of goods sold.
And that's the only item that wouldn't be there.
Yeah, I mean, they might have different expenses, right? You'll look at different types of businesses, and like they probably wouldn't have freight out because they probably don't ship anything to anybody if they're a service business. So yes, but recognize that all businesses will have a different chart of accounts. Like if you come into a business and they're already operating, the accounts they use might be slightly different from another business. Other questions?
Thank you.
Yeah, go ahead, Faz.
I got one for you. Yeah. Sorry, I'm not sure the exact word we used for it, but so I'm trying to explain it, what word I'm trying to find. So if I am a merchandise company and I've sold something for, or I'm buying something for $10,000 and they send me the product, and that one's, I paid it now. So I've already paid off the account. I pay it as soon as I gets in the truck and it's being sent to me. Right? What is that one called? The FOP or FO. What is that one called?
FOB. So if if I'm the purchaser or the buyer, okay, and so it becomes my property when as soon as they load it on the truck, that's FOB shipping point, meaning the ownership changes hand at the shipping point or where it was sold from.
Okay, gotcha. Okay, and then okay, here's another example. So for me, I bought dumbbells, for example. So I ordered them, and I didn't realize there was a shipping charge in addition to that. And sorry, this was not a question, that was the interpreter. So I've had that experience in the past where an FOB destination was charged to me, but I wasn't aware of it. So is that something we have to let people know ahead of time on our end, on the accounts receivable or the accounting side? Is that something we have to say, or how does that work?
Yeah, so typically it's just good business practice to let people know exactly how much it's going to cost them. So if they're paying for shipping and handling, it would be important to let them know. That's not really an accounting issue as much as it is a marketing and customer relations issue, to let people know, and probably a legal issue. I think what would happen is if you routinely didn't tell people that it was their job to pay for the cost of shipping, and they didn't know that until it got to them, as they would just return it to you. I think you'd lose sales and end up covering those costs. So, from an accounting standpoint, and most things right now, things we buy online, typically it has the shipping and handling right put into it, and we pay that right there when we make the the purchase.
Okay, gotcha. That conceptual difference makes sense for me. I was trying to wrap my brain around it there. I appreciate it. Cool. Thank you very much.
Okay, thanks. All right, any other questions about this, or maybe homework problems you want to look at?
I have problem here.
Okay.
It's for this week with about gross profit rate and the profit margin and the quality of earning ratio. For these three rate, because confuse me to understand. Is higher or lower is better to decision maker to see this rate. Could you explain more detail for
Sure.
this three
Sure.
rate and why we need to use these three rate to
Sure.
help the decision maker?
Sure. You said gross profit rate. Can you repeat those for me?
Gross profit rate, profit margin, quality of earning ratio.
What was the last one again?
Quality of earnings ratio is the net cash provided by operating activity divided net income.
Okay, so So the gross profit rate is just, it's asking ourselves what percentage of our sales were we able to convert into gross profit. So it's our sales minus our cost of goods sold, right? And so the way we use this most often is if we're comparing our business to our business in previous periods. So we can look at the gross profit rate or the profit margin ratio for that matter. We can say, what was it last year? What was it the year before? And compare it to ourselves and look at those changes and see, are we, because really, if you think about it, the only thing that's going to cut into our gross profit rate or reduce our gross profit rate would be either that we are selling the product for less, we're making less on sales for the same amount of product, or if our costs of the product are going up, okay? And so we can use that for a trend analysis to see over time, how are things changing. The other thing we use it for is we compare the gross profit rate or the net, the profit margin to other companies that are similar to us. So if we can see that our competitor has a gross profit rate that is much higher than ours, we should be asking ourselves, what are they doing differently than us? Are they buying their supply or their inventory from someone who's doing it much cheaper? Are they buying in bulk? Are they cutting their shipping costs? And if our competitors are able to have some advantage that way, we might want to look into copying them, right? Doing what they're doing. Or if we're going way better than our competitors, then we might ask ourselves other questions like, how do we continue to have this advantage? Or are we sacrificing product quality? Is that why it's so much cheaper? And are we going to have to deal with a lot of more customer complaints or things like that? So the profit margin, or the net margin, sometimes it's called, that is just our net income divided by our sales. And so that's asking us how much of our total sales are we converting into net profit or net income. That's important because if we don't have a net income, then we're out of business pretty soon. We can't operate very long at a loss. And so again, same thing, we use it to compare ourselves in previous periods and say, are we improving or are we or not improving? And then also to compare against our competitors. Why is it that my competitor seems to be able to make a better profit than I can, or what am I doing that's helping me do better? We have to be careful when we compare against competitors that the competitors have a similar enough business model to ours, and that they're truly a competitor. For example, I owned a storage business, and so most of my cost was buildings, and so those buildings were already paid for, and so my net profit margin looked really high, something like 70%, or that would mean 70 cents of every dollar in sales became profit to me. But my sales were small. They're only like $20,000 a year. You could compare me to Walmart. Walmart has a profit margin of about 1.2%, which doesn't sound like very much until you see that their sales are in the hundreds of billions of dollars, and 1% of 100 billion is a billion, right? So, and so we always have to be careful when we compare those numbers that we're dealing with, a similar enough business. The last one, so our net cash divided by our net income, I think is what you said. That is just, again, cash flow problems kill businesses. If you're selling lots of stuff, but you're not collecting the money that your customers owe you, you'll go out of business because you won't have any way to replace that inventory. You'll just have a whole bunch of people owing you money, which doesn't do you very good. And so again, trying to understand, again, are we improving or not improving in that area? Or are we able to convert money into cash better or worse than our competitors, is the way that a business manager would use that information. That was a really long answer. Sorry.
Thank you. So may I understand to the gross profit rate and the profit margin? If the number is higher, so that means the company runs better?
So typically, yes. So higher is better with all three of these, actually. So if your gross profit rate is higher, it means you're creating more gross profit for the same amount of sales, right? If I always try to think of these in terms of a it's a fraction. And so if it's gross profit divided by net sales, then the only way to make that rate go higher would be either to increase the numerator or decrease the denominator. So we can either increase our gross profit for the same amount of sales, or have our gross profit stay the same with a decrease in sales, and either of those two scenarios would increase the gross profit ratio. So gross profit rate or ratio, higher is better. It just means you have more gross profit relative to your sales.
Okay, got it. Thank you.
I always feel bad for the interpreter when I'm just blasting through all these specialized terms. Sorry. Other questions?
You're totally fine. I'm with you.
All right. Okay. Oh,
So quick question from
okay.
File. This PowerPoint, where can I find that? Is that in our course or?
Yeah, so let me show you where you can find it. Let's see. So if we are in, so if I go to the, so here I am in the home page of the course, and I go to modules, and I go to Wiley Plus Read, Study, and Practice, so the textbook information for the course. And then I wait half an hour for it to load. There it is. Choose the chapter you want from the drop down, and then just scroll down a little, and here's the PowerPoint review. You'll see that the publisher there's about 90 slides in there. I cut it down to 10 or 15 that I think are really the most important. Otherwise, everybody would hate me if I talked through 95 slides. But the whole PowerPoint review is here for you. There's also an audio review, which that's not put out by me, that's put out by the publisher. I will say that Wiley gives more resources than most people could ever use unless they had unlimited hours for studying. I'm sure all of you have unlimited hours.
So can you go back and show me one more time where that is under modules?
Sure. So here I am at the home page. I click modules. I'll scroll down to the textbook access module and the Wiley Plus Read, Study, and Practice link. And that brings me to this set of tools. So same place you do your, if you're reading through the chapters in the textbook, it's all in one place. So this is sort of all of the resources that the textbook publisher has.
You're good to keep going.
Okay, I think we're wrapping up here. So if we're good, any last chance, I guess, for questions before we, oh wait, somebody's in the chat room up here. Let me make sure I. Okay. So I got someone asking me to review homework problem 5-1, and I will gladly do that. Also recognize if you're in here and we're into the question section and you've got to go, I would never think that you're being rude. Okay, I understand everybody has lives and families and stuff. So if, let's say, for example, right now you had already finished that homework problem and we're like, I don't need to go over this, I would not think you were rude if you left. So I'm not telling you you have to leave. I'm just telling you I won't judge you. No judgment. Okay, so let me pull up homework problem 5.1 and we can take a look at it. Unfortunately, when I pull it up on my end, it already has all the answers in there, so I can't like work through it for you. Let's see. I mean, I'll talk through it, but it's already there. So we're talking about problem 5.1a, I'm assuming, not exercise 5.1. Okay, so I went to problem 5.1a. Let's see, let me share my screen with you again. Oh, brief exercise, okay. All right. Yeah, this one can be a little bit mean. Like it makes you feel like it took your lunch money or something after you do it. Let's see. So presented are the components of the Columber Company's income statement, determine the missing amounts. And so in essence, they go across revenue, cost of goods sold, gross profit, operating expenses, net income. So what they're trying to get us to do here is recognize the relationship, the interrelationship between each of these items, right? So we know that if I were to write this out algebraically, I would say it's revenue minus cost of goods sold equals gross profit. Gross profit minus operating expenses equals net income. So then I should be able to sort of do this algebraically and say, okay, so in this first year, if I know my revenue and I know my gross profit, I should be able to figure out my cost of goods sold. So if revenue minus cost of goods sold is gross profit, then revenue minus gross profit is going to be cost of goods sold. So I can do that. Gives me 42,790. And then I know my gross profit minus my operating expenses will be net income. So if I change that algebraically, I could say gross profit minus net income will give me the operating expense. So 32,800 minus 14,370 should give me 18,430. On the second one, I know my revenue, I know my cost of goods sold, and I know my net income. So revenue minus cost of goods sold will give me the gross profit. And then I can go gross profit minus operating expenses is net income. So gross profit minus net income will give me the operating expense, is how I would do that one. Last one, it gives me cost of goods sold, gross profit, operating expenses, and I need to find net income and sales revenue. So my cost of goods sold, so if I know that revenue minus cost of goods sold equals gross profit, I can, again, algebraically say then my cost of goods sold plus my gross profit should equal my sales revenue. And my gross profit minus my operating expenses will give me my net income. So I don't know, that was really fast. Was that helpful? Or do I need to slow down and work it out more? I guess I'll call it good. Oh, wait, there it is. Okay, operating expenses. So our operating expenses will, so in real life that we would know those, okay? We would calculate we would know what our operating expenses were. But from a algebraically speaking, we know that gross profit minus operating expenses equals net income. So if we have those, if we have two of those, we can find the other one. So if it's gross profit minus operating expenses equals net income, it could also be gross profit minus net income equals operating expenses. So on this second one, we have to calculate gross profit first. Then we can use that same formula of gross profit minus net income equals operating expenses to find it. In real life, it's what we would be tracking all period long by doing our journal entries, right? Would be tracking those operating expenses. So this is more about the interrelationships. All right. Any other questions? All right. So why don't we offer a closing prayer? And then I think Kyle, you said you had a question that you wanted to talk to me offline. John, did you have a question, or I saw you come off mute?
Yeah, could I ask you a question or two after class?
Oh, was it John? Sorry, not Kyle. It
Yeah.
was John. Okay,
That-
my bad.
that's-
Yeah,
yeah,
thank
yeah.
you. All right. Anybody willing to offer our closing prayer?
I will.
Okay, great.
Dear Heavenly Father, thank you for the opportunity for Brother Fox to help us do this exercise. Please bless all those who are struggling on the world in this time of the pandemic and its recovery. And please bless everyone in class has an opportunity to learn and improve on their accounting homework. And please bless all the missionaries and armed forces in our country serving. And I say this name in Jesus Christ's name. Amen.
Amen. Thank you. All right, I'm gonna stop recording.